welcome to this month's webinar. My colleague Sean van der Berg, who usually does the webinars, is currently enjoying a well-deserved break, and he's asked me to send his regards to all regular attendees. I have already done a sound check or two. Thanks, Glenn, for responding on that. If anyone can't hear me, please can you just pop a chat in the chat box to say that you can't hear me, and I'll try and rectify the problem. But yeah, let's get the show on the road. This is the agenda, and it's the topics that I will be covering today. As you can see, it's quite extensive. So in keeping with the usual flow of these presentations, I ideally ask of you that we reserve any questions you may have until the end of today's presentation. Which brings us to the first question. What exactly are we buying when we are buying a unit in a unit trust? And how does one best describe what a unit in an investment portfolio is? That is the big question. Well, first, let's tackle some terminology and get that out of the way. You will often hear people in the industry use the terms funds, mutual funds, investment portfolios, unit trusts. Some even refer to bundles or baskets. In the end, it is different names for the very same thing, that being an investor buying a unit which represents part ownership in a registered and regulated investment fund where your money is pooled along with that of other investors in the fund. But now you say to me, Aubrey, in previous webinars, PSG has told me that if I buy shares in a registered company, that I also part own the company along with other investors. So how exactly does a unit trust then differ from share investing? In keeping with one of the definitions, namely a basket, let me try and explain this by way of an analogy. Lend me your thoughts for a moment. Let's say that you have just opened a restaurant, perhaps even with a friend or two who are now your partners, since they invested some capital along with you. You have some bright ideas for the place, and you firmly believe that you have a few brilliant recipes which will attract crowds of patrons. You then walk into the local supermarket to buy your first ingredients. There you notice Jamie Oliver, Gordon Ramsay, Nigella Lawson, shopping for their restaurants. You know them. They are famous, and their establishments have been successful for quite some time. Their recipes are proven and have stood the test of time. Suddenly, you become a bit despondent. You weren't aware that there was such stiff competition within your area. You don't want to believe that you should compare yourself to them. Recipes and cooking styles, and many other features aren't comparable, surely. However, if your new venture doesn't outperform these, what future is there for your business? How soon will one of your partners perhaps approach them without you to rather open up another franchise of their establishment instead of trying to reinvent the wheel with your diner? The same kind of concept is true for investing. You need to objectively ask yourself, can my portfolio, or even a portfolio of a club of investments together like you and some of your friends, beat the professionals? Is my or our strategy and ideas unique and out of the ordinary? And how am I going to compare the portfolio against these peers going forward? And at what point do I think, I will rather just buy a portion of a franchise, in inverted commas, or in this case, an established investment fund? So before we can perhaps ask properly, now that we know what a unit trust is, perhaps we can ask, well, then why buy unit trust? What's the advantages? On this slide, we show recent closing prices for the JSE top 10 companies. If you wanted to buy one of each share, it would cost you, based on quick arithmetic on my part, around 5,000 to 6,000 Rand. Yet in a unit trust, you can part own a variety of underlying shares that the fund owns for a nominal debit order amount of, say, 500 Rand per month, which kind of lets one believe that there is cost efficiency advantages to owning a unit trust. And then we haven't even touched on the brokerage that one would pay in a share account. Further reasons why buy a unit trust: diversification benefits. I borrowed this graph from the Coronation Top 20 Fund fact sheet. Considering only basic materials, financials, and consumer services as industries collectively, and look at the percentages, one gets a sense of how much weight those sectors carry in relation to others on the Johannesburg Stock Exchange, perhaps even disproportionately so. If you are a firm believer that one should have your fingers in many pies to earn decent passive income, then surely you would select unit trusts, which more evenly comprises of different sectors of the economy. These are the kind of aspects which active fund managers are also acutely aware of on behalf of investors in their funds every single day. Last reason, and that's the requirement of share picking. Now, not to detract from Sean's teachings in earlier webinars, share investing, according to a strategy that has succeeded and failed, and which you have learned from and refined over time, can be extremely profitable, no doubt. But coming up with that strategy takes time and a lot of effort, and more often than not, even extensive trial and error. Some investors have very serious careers and other commitments which take up their valuable time. So many investors argue, let me simply pick a fund or three that I like and that has delivered solid performance over time. From there, I will leave the underlying investment decisions to a fund manager, and if necessary, the reporting duties and recommendations on my account to a paid financial advisor who meets with me once a year for a review. Stated in other words, many investors outsource, again in inverted commas, the investment decisions on their portfolios to full-time fund managers, as well as teams of analysts working under those fund managers, because they themselves as investors are simply not comfortable being part-time analysts or researchers of the market. So how do we get exposure to unit trust? Unbeknownst to many investors, they often already have exposure to unit trusts, which for instance underlie their pension and provident funds at their employers. This can be seen as products under the awkwardly named compulsory category. Not just are contributions to products in this category sometimes compulsory. For instance, if an employment contract mentions that it is mandatory for you to belong to an employer's group scheme, but these are the products which has strict rules regarding access to capital. These products, again under the compulsory category there, generally only has access to capital at age 55 or any elected retirement age thereafter. Products in the discretionary space next to it, say for term products, which has some rules of its own, generally has more liberal and inexpensive access to capital invested. And lastly, is the first column there, which is direct unit trust, which occurs when an investor approaches an asset management company and applies directly. In other words, the unit trusts are not owned on a product or platform by the investor. So you may ask, why all the possibilities and products? Well, products in the compulsory or discretionary space often addresses investment aspects like tax planning, retirement planning, estate planning, including the nomination of beneficiaries, where direct ownership of unit trust in the first category over there doesn't always address those perspectives. Okay, Aubrey, you might say, you have somewhat convinced me that fund managers are prudent and responsible with investors' money, but there are so many funds, so what exactly do they invest into? Well, first and foremost, shown here are the asset classes or categories of financial market instruments that funds invest into, namely equities or shares, for instance, JSE listed companies, property, bonds, which are listed medium and long-term debt of companies, and cash, which is money market instruments traded between banks and other banks or companies. And then there are also all of these very same asset classes, as I've just mentioned, but in markets that are based outside of South Africa, hence the offshore component there. So your next question will probably be, well, which is the safest and which is the most risky? This theoretical risk spectrum shows us not only that the higher the risk, the higher the expected level of return, but also that cash is generally least risky and shares are most risky. Logically, you can deduce already that there is nothing preventing any investor from holding a combination of all asset classes. And such a person would therefore have a balanced portfolio with moderate risk. And that would be logically correct of you to summarize. Perhaps a topic for another day. One can always argue whether this theoretical risk spectrum always stands. A vital fact to keep in mind, and it is something I often stress to prospective clients, unlike institutions where you can receive fixed returns on your money, think for instance of a fixed deposit at a bank, any investment in unit trust funds you make is market linked. Therefore, if the market sectors you have chosen with your unit trusts is exposed to, or that your unit trusts are exposed to, performs well, your investment will perform well. But the opposite is also true. Your investment can underperform and even lose money in recessionary economic cycles, or when certain sectors have fallen on hard times. Think, for instance, of the property sector, just as a brief example, where people weren't shopping a lot anymore during the lockdowns, and how much those companies have really suffered due to rental income. Although I will touch on fund fact sheets a few slides later, the information one can get from it, such as the fund mandate or the fund's investment objective, as well as its spread of asset class allocation, will give you a particular view of the risk that the fund is taking. And that is so for any fund on from any asset management company, especially when considering it against the theoretical spectrum, theoretical risk spectrum, which I just showed in the previous slide. Okay, Aubrey, problem is that there are still so many funds to choose from. So how would one even begin to narrow it down? You will note in the footnote to the slide that I got this diagram from a document on fund classification, downloadable from the Association for Savings and Investment South Africa, or ASISA's website. It's a good document to have on hand when you want to see the rules of what certain funds may invest into and what not. One of the key things you will note is that 3 of the South African fund sectors shown here correspond with the asset classes that I've shown you in the previous slides, namely equities, real estate or property, and interest-bearing, which is just a collective term for cash and bonds. The 4th sector of funds, termed multi-asset portfolios, are for funds that invest in a combination of 2 or more of the asset classes. It is worth noting, albeit perhaps also another topic for another day, that legislative prudential requirements for all regulated retirement products make it unlawful for retirement products not to invest in a combination of asset classes within those products. And this is governed by the Regulation 28 of the Pension Funds Act that you may have heard of previously. In a nutshell, retirement funds are obliged to invest into funds which are Regulation 28 compliant. And that should give you, as an investor, especially with your long-term capital, a little peace of mind that the fund managers in your retirement funds aren't taking any undiversified risks. As further examples of fund classification from the ASISA document, in this slide I show you extracts of fund rules or limitations, which are those put in place. For instance, an equity fund needs to invest into a minimum of 80% of equities, and a global portfolio needs to invest at least 80% of its investors' money outside of South Africa. Naturally, these rules or limitations are sensible to ensure that investors can't be misled into investing in an incorrect fund. By way of the fund name and the investment objective, which I showed in the previous slide, they therefore can have a firm expectation of the kind of underlying investment that the fund will hold at all times. There are also helpful online websites such as our Funds A to Z, and I've put the web address there for you in the footnote, which enables users to search funds that fall into certain categories. So if you have an idea of the risk you want to take with your portfolio already, then there's nothing stopping you from narrowing the options down or creating shortlists within certain categories that you are interested in. Well, Aubrey, you might now ask, how do I know what kind of risk suits me? Am I a conservative, a moderate, or aggressive investor? Let's answer some questions subjectively. Your intended investment, what is the purpose? Would you need to call up those funds tomorrow in the event of an emergency? Or are we talking about you wanting to almost forget about the money for a long time and live off it in your old age? Well, obviously, the longer you have, the more time is on your side to help your portfolio recover from any downfalls that risk-taking can bring. Remember as well that we said with increased risk-taking comes the potential for increased growth, especially over time. What about your circumstances? If you earn commission, for instance, and you have a bad month, who in the home is going to put food on the table? Therefore, you may be necessitated to access the capital sooner than you think, and even unexpectedly. And what about your character? Are you the type of person who would skydive or bungee jump any day? Then chances are that you can stomach a 20% loss on your portfolio, just as long as you, as a person, know that there is a potential upside of 70 or 80%. I hope you get the point that I'm trying to make in this slide. Certain people are naturally inclined or just better positioned to take risks compared to others. There are also a number of online sources or tools, such as the Vanguard example shown here, not to even mention robo-advisors, and you can Google that, which is of late a popular craze amongst self-advised clients, which requires that you complete a questionnaire in order to determine a score for your risk tolerance. Typically, such a score then categorizes you as a conservative, moderate, or aggressive investor. So how do we interpret fund fact sheets if we now have a short list that we compiled? How do we decide between them? These are also referred to as minimum disclosure documents, or MDDs, that you'll sometimes see on companies' website. And the first step is to download it from the particular asset manager's website, be it PSG, Allan Gray, Coronation, or any of the other fund managers listed in South Africa. I'm not going to spend a lot of time on this slide since we have looked at risk and fund classification in previous slides, but on this slide you can see that those features are clearly mentioned on any given fund fact sheet. Staying with the example of the PSG balanced funds, which I've illustrated in the previous slides, the asset allocation of the fund here shows that domestic and foreign equity combined accounts for the lion's share of the weights in the portfolio. And that is now if you take the 49.3% and you add the 23% over there. In the top 10 holdings, you can also see if the company owns or if the company shares that the fund owns are well-known companies that you might be bullish on. And if you're not bullish on them, you can read up a bit on these companies and ask the fund manager during the company's next roadshow. There are invites that send out from asset managers on a regular basis. You can ask a fund manager his fund view and determine why the fund is necessarily bullish on those companies or those sectors. So breakdown of the fees are also regularly displayed on fund fact sheets, and they aren't always provided by all funds. In this example, though, they are, and one can see how the expenses of the fund translate into what we call a TER, or total expense ratio, and eventually a TIC, or total investment charge. In this instance, on a capital amount of, let's say, 10,000 Rand, which has remained unchanged for the past year, fees of 143 Rand, that being the 1.43% that's illustrated there, for the year, or roughly 12 Rand per month, would have been charged within the fund. Other elements of costs can be product fees if the unit trust is held in a retirement annuity or tax-free investment plan, as we mentioned earlier, and also advisory fees should you have an advisor appointed to your unit trust or product wrapper. When looking at fees, it is always it is always important to ensure that you are comparing apples with apples, especially when looking at other company fund fact sheets as well. And it is crucial to bear in mind value versus costs. If you are earning double-digit returns in any given fund, not only are you comfortably beating inflation at the moment, but who then minds to pay a defined or even a fluctuating percentage for solid performance, such as in this case 1.43%. The reality is that fund managers and analysts are very serious about delivering outperformance, not just because they take their job seriously, but due to them often having some of their own money invested in these funds. Ultimately, they are in this stressful line of work for the monetary rewards that they can enjoy for delivering outperformance to all investors in their funds. Lastly, and on this slide, when we get to the distribution section, funds have different distribution dates. Here we can see that the PSG Balance Fund has distributions twice a year. Now, you may ask, what is distribution? So this is where income earned by the fund, such as dividends, rental income, and interest, on behalf of the investors, is distributed to the investors and no longer kept within the fund. Unless investors has specified explicitly that distributions are to be paid out to them in cash, the norm is, in the industry, for the distribution to purchase additional units in the fund for the investor's account. Again, unit trusts are very liquid, so if at any point in time you want to do a withdrawal, it's not, you can just withdraw from the units in the fund, and it doesn't really matter whether it's close to a distribution date or not. And then performance. This is often the most popular area of a fund fact sheet, and sadly, it's the first thing that investors often focus on, especially how the fund has done lately. Like us in sales, they say, you're only as good as your last month. And the sad part, like I said, is that sometimes people focus on the short term. And top performing funds of today is seldom the top performing funds of tomorrow. It is better to look at the long-term performance of a fund, at least 7 years plus, and also to do some research as to whether the fund is frequently in the top quartile of performing funds in its sector versus its peers. Cumulative figures relate total return since inception on this fund, being the 116.63% that you can see there. That would mean 11,663 Rand profit on an investment of 10,000 Rand at inception of the fund. Annualized figures, which is just below that, annualized figures portray an average of that performance over the years. Hence, this fund has an annualized performance of 9.54 since inception. That means that on average, it will return 954 Rand per year on an investment of 10,000 Rand, assuming that there has been a static balance on the fund from inception to date. On the aforementioned PSG Wealth Funds A to Z website, we also have a very useful mega fund fact sheet function. which allows you to pull performance data over various periods for most or all funds listed on the PSG Wealth platforms. Getting this data into Excel would mean that you can filter and sort and arrange a short list of funds according to your preferences and parameters. And this is particularly useful. Lastly, there are also various other sources that unit trust investors can subscribe to, or websites that one can visit, such as Morningstar, Funds Data Online, MoneyWeb, and Assisa. So if you're still having doubts about your fund analysis skills and your ideas around portfolio positioning, but you at least have an idea of your risk profile, why not consider a fund of funds as a solution to your investment decisions? Here you are able to let the fund manager choose a selection of unit trusts for you, and in so doing, you outsource investment choices in your portfolio that I alluded to earlier. We have 3 such portfolios that are ideally positioned to PSG direct clients, depending on whether you're a conservative, moderate, or aggressive investor. The fund manager on these funds is our Chief Investment Officer, Dr. Adrian Pask. On the investment committee of these funds with him are several of PSG's senior analysts with years of experience. Collectively and with very unique and meticulous strategies, these teams have produced top quartile risk-adjusted returns over various terms and have won several awards. I don't want to joke about it, but these kind of funds are a good way. These fund of funds are a good way to be a lazy investor. Just check in every now and then to monitor your performance relative to benchmarks in the market, and over time you may be very pleasantly surprised. I want to leave you with the following pointers to focus on in compiling a short list of funds. Firstly, establish and understand your risk profile and your preferences. Don't be afraid to come up with a mantra as a result of your risk preferences or a calculation of your optimal or your target asset allocation. For instance, you might be as bold as to say, I want 30% invested in local shares, 10% in small cap shares, 20% in global shares, etc. Focus on certain fund categories within your target asset allocation, and then delve into fund analysis and comparing funds. Lastly, always ask yourself about the potential benefits that a product can add to your unit trust investment and the purpose for your investment. As we alluded to, there are tax planning, estate planning benefits, etc. It might seem I'm leaving you with a bit of an uncertain or fill in the dots for yourself kind of checklist, but in this slide you will see that a personalized checklist can make all the difference, even to seasoned investment professionals. Charlie Munger being Warren Buffett's partner, one of the most successful investors ever. I'm going to leave this last slide here with some additional pointers to serve as some last food for thought whilst I open the floor to questions. So if you have any questions, please fill those in the chat box and I'll answer them. Oh, here's our first question. Why do funds have different letters at the end of their names? Thanks for breaking the ice. I'm not going to mention any names of the participants, but thanks for breaking the ice. This is a question we often get. It refers to different fund classes. Essentially, there's no difference in underlying investments of a Class A of a fund versus a Class E of that same fund. All clients have the same exposure within that fund. However, Allan Gray or Coronation, for instance, might create a special or an institutional class of their fund for a company like PSG, and we have very popular online platforms or products, so they would want to get a lot more business from our clients. Thus, if they offer their funds on our platforms at a discounted rate, it's better for them, it's better for us, it's better for you as an individual. Therefore, it's often possible for an investor to get a lower total investment charge for a fund using a popular and well-known company platform like ours versus going to that asset manager directly and purchasing a direct unit trust as a retail client? I hope that answers your question. Otherwise, just pop me a message there in the chat box and I'll further elaborate. Oh, we've got one more question. I often read in the media that passive funds are better than active funds. What is the difference and why would I want to hold either or both of these type of funds? Thanks, that's a very good question. Perhaps I should revert back to my analogy of restaurants earlier. Just as an example, but think of passively managed funds. Just an example, like I mentioned, but if you can for a moment think of passively managed funds in the same light as you would a McDonald's or a Burger King. You know it's affordable versus a contemporary or a boutique steakhouse in an affluent area. And it does serve the purpose that it fills your tummy, but you're very seldom going to experience euphoria along with your meal, and you probably won't write any Google reviews for an ordinary franchise like that. Similarly, passively managed funds or index funds will help your portfolio to replicate the performance of a range of shares, also often known as an index. Such as the JSE Top 40 companies or the Standard & Poor's 500, which is the top 500 companies listed on the New York Stock Exchange. These funds, or these passively managed funds, won't seek to outperform the indexes, but merely track their performance. Therefore, you can do so at a reduced rate in these funds because they don't have fund managers that are looking to outperform. On the contrary, actively managed funds has these indices as their benchmark, and they seek to deliver outperformance. Like I alluded to earlier, some fund managers have their own money invested and also earn decent money from managing those funds. A fund that consistently outperforms the market on a long-term basis can be of incredible growth benefit to your portfolio. But in the end, I would say neither passive or actively managed funds in the industry are seen as the holy grail of investing. Both of these have approaches that have advantages and disadvantages. And often more experienced investors employ a combination of the two, being actively and passively managed funds. Any further questions? Well, ladies and gentlemen, thank you for attending today's webinar. Should you have any further questions and want to ask them offline, please feel free to reach out. I'm going to bring up that slide quickly for you. Please feel free to reach out to our team of investment specialists at in the direct sales team, and we'll be happy to call you or get back to you with an answer. Thanks for attending today, and I hope you have a lovely day.